Have you ever looked at a financial chart and just felt completely lost, like you're trying to read some ancient foreign language? Well, today, we're going to find the Rosetta Stone for all those squiggly lines. We're going to break down how to find real patterns in what looks like pure random chaos.
I mean, just look at this chart. It's up, it's down, it's all over the place. It looks completely random, right? You're probably thinking, how on earth could anyone make an intelligent decision based on this? It really does just seem like noise. But what if I told you there's an entire discipline dedicated to finding predictable patterns in exactly this kind of data?
And that's exactly where we're going to start. It's all about making sense of that noise, turning what looks like chaos into something we can actually understand. The framework for doing this is called technical analysis, and honestly, it's a pretty fascinating mix of art and science.
So what is it officially? Technical analysis is simply the study of market action, and by that we mean price and volume, using charts to try and forecast where prices might go next. But here's the absolute key. Technical analysts don't really care why a price is what it is. They're not digging through company earnings reports or economic data. Nope, they focus only on what the price is doing.
You know, this entire field is really built on a foundation of just 3 core ideas. If you can get your head around these 3 assumptions, you'll basically understand the whole philosophy behind technical analysis. The first assumption is a really big one. The market discounts everything. What that means is that any little piece of information that could possibly affect an asset's price, we're talking news, earnings, politics, investor mood, you name it, is already baked into the current price. The price in this view is the ultimate truth.
Second, and this is a direct answer to that chaotic chart we saw, is the idea that prices move in trends. The core belief here is that price movements aren't random. Once a trend is established, whether it's up or down, the price is more likely to keep going in that same direction than it is to suddenly reverse.
And the final cornerstone is the belief that history tends to repeat itself. Now, why would that be? Well, it's because chart patterns are really just pictures of market psychology. They're visual representations of timeless human emotions like fear, greed, and hope. And since human nature doesn't really change over time, the patterns created by those emotions tend to pop up again and again. Okay, so if prices move in trends and our job is to spot them, then we need to learn what they actually look like. It's time to learn the basic language of reading a chart.
And this is the whole game right here. The number one goal for a technical analyst or a chartist is to figure out what the current trend is as early as they can and then trade with it, not against it. You've probably heard the old saying, the trend is your friend. This is where that comes from.
And this shows the 2 main flavors of trends perfectly. An uptrend is just a series of higher highs and higher lows. Seriously, just think of it like you're climbing a set of stairs. A downtrend is the exact opposite, a series of lower highs and lower lows, like you're walking right back down those same stairs. It's that simple and that visual.
Now within these trends, prices don't just move in a perfectly straight line. They bounce. They hit what seem like invisible barriers. So let's talk about the floors and the ceilings of the market.
These barriers have names, support and resistance. The easiest way to think about it is that support is like a price floor. It's a level where buyers tend to jump in, see value, and start buying, which pushes the price back up. Resistance, then, is the ceiling. It's a price level where sellers start to take over, cash in, and push the price back down. It's a constant tug-of-war between buyers and sellers.
And here's how that dance usually plays out. First, the price falls until, boom, it hits that support floor. At that point, buyers see a bargain, and buying pressure picks up, causing the price to bounce. As it climbs, it eventually hits that resistance ceiling. Here, sellers think, this is a great time to sell, and their selling pressure pushes the price right back down again, often creating a kind of channel between these 2 levels.
But what happens when a floor or a ceiling breaks? This is where it gets really, really interesting. Once a support level, that floor, is broken in a meaningful way, it can actually become the new ceiling or resistance. The whole psychology of the market at that price has flipped. What was once seen as a good deal is now seen as a point of pressure.
Okay, with all of these tools, trends, support, resistance, it is absolutely crucial to understand what technical analysis is and, more importantly, what it is not. This is a powerful framework for looking at markets, but it is definitely not a crystal ball.
To put it all into context, let's just quickly compare it to the other main school of thought, fundamental analysis. Technical analysts study the effect, the price itself. They're asking, what is the price doing?
Fundamental analysts, on the other hand, study the cause, the underlying economics, the company's health. They're asking, why is the price at this level? They're just two different lenses to view the very same market.
So if you take one thing away from all this, let it be this. Technical analysis gives you a way to identify and follow trends. It gives you a method for gauging the collective psychology of the market. And maybe most importantly, it gives you a framework for managing risk. But what it is not, and never will be, is a magic tool for perfectly predicting the future. It's all about probabilities, not certainties.
And that really brings us to a final, pretty fundamental question. If all these chart patterns are just pictures of human emotion playing out on a grand scale, then what's really driving the market? Is it the cold, hard numbers you find in a financial report, or is it the timeless, powerful, and let's face it, often irrational cycle of human hope and fear?